That never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself. But at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it.
WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it. Might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That, you know, they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, you know, we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it.
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment, to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we have developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, Most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright brothers airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Has Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle. Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation, still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos. And then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile-high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, you know, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
The first time, people are going up into space and not sent there by a superpower like the United States or Russia or China, well, that's like really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space like really affordable and accessible for everybody, so that you can have fishing buddies going to space someday. But the first is special, and so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You just blow them up, and they get a nice big size for about less than half the weight probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
This is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers to be in those contracts. So, for example, the FAA says, well, we're not going to make you make your spacecraft to a certain safety level. We are going to make you, spacecraft operator, make sure that you inform your space tourists of all of the hazards that you know of. I'd imagine a very long waiver, all the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities. It doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls. You step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin, that's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. Or the bizarre tufa towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan, and his crew, Heron,
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name is Jan Srostra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over. That's cool. Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. They've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. I'd be like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. You know, make sure you follow, good steps for leaving no trace.
as a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and yeah, no problem. We just wanted to get through.
It was a beautiful choice. Glad we got out of the smoke. Whoa, okay. But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky,
Look at it.
strip malls of the Central Valley.
We have made it sort of out of the smoke all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. So we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of California. Very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts.
Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots.
On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think, like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command.
So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley or like throughout the U.S. or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019?
Yeah,
right?
So we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay,
so.
And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap.
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very, very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
I like you. Who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is Ellie Q.
Can I take her out for a spin?
Please.
Ellie Q, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her. Or that they miss
Literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
Ellie Q isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
Ellie Q, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month. How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of Ellie Q, from the way Ellie Q moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
Ellie Q, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. Ellie Q?
Yes?
Schedule a doctor's appointment.
No problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the U.S.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more because she understood the fact that you need to run after your dreams and work really hard no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas. Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can't say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style. So what's the kind of thing you used to wear to a conference?
Stuff like this, blousy things that make you look like you're 40.
But that got old after a while. And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly the print was, I could see that quite clearly.
What about this?
Well, I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling. Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. am using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
if you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point, because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Brokers studio. We are streaming on YouTube and Bloomberg Originals. It is Wednesday, March 15th. Is it the Ides of March, or was that yesterday? Is it the Ides of March, everybody? I don't know. I think it is the Ides of March. It is. What I do know for certain, it is 1 week from next week's Fed meeting, and we got a lot of volatility back in the markets.
We definitely do. And tomorrow, in fact, Carol, is actually the 1-year anniversary when the Fed began this hiking cycle. Everyone was questioning, when are things going to start to break? All of a sudden coming into this week, and now we're beginning to see that.
Yeah, so, okay, the back and forth, we're going to cover all of that. We're also going to hear from former U.S. Treasury Secretary Larry Summers talking about what's going on in global banking, certainly coming off of Credit Suisse. We also have a great roundtable in terms of covering what you need to know about what's happened to Credit Suisse in the last 24 hours and what it means for some of the big banks here in the United States.
Along with that, we're also going to take a closer look into the softer retail sales report today, what exactly that means for the Fed, also how TikTok is considering splitting from its parent ByteDance as well. And later on in the show, we're going to take a look at the most vulnerable and important profession in the U.S., Carol.
Yeah, and just going back to banking, because that is certainly front and center, we're going to take a look at how the collapse of Silicon Valley Bank, remember, we were talking about that a lot earlier in the week and certainly late last week. So much news over the weekend as it collapsed, but how it threatens an already fragile economy. Jess, you mentioned that softer retail sales report. We are seeing some economic data points come in with some softness, which is a good thing for the Fed as it looks to really get inflation under control, looking for some of that softness. But it does also make you wonder, what does the Fed focus on next week? Is it going to be fragility, perhaps in the banking sector, some nervousness there? Or is it, as the CPI reminded us, there's still inflation out there?
Definitely. In addition to that softer retail sales report, we're also looking at those producer prices in addition to that coming in cooler than expected. So that is a good sign.
All right, everybody. Right now, over to our TV colleagues we go. We're going to talk about the markets. Countdown to the close starts right now.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left here in the trading day on a Wednesday afternoon. Romaine Bostic here alongside Scarlett Fu, joined right now by our colleagues in the radio fishbowl, Carol Massar and Jess Menton, on a day where we see equity markets reeling. Carol Massar, bets on volatility elevated Carol Massar, and a flight to havens. Carol Massar.
All right. Well, Romaine Bostic, what a different, though, tone, I feel like, in the last half an hour, at least on the equity side of things. Treasuries, we'll get into that in just a moment. Having said that, we're all about the banking community, and we did see, actually, UBS coming out with a call. They initiated coverage on 19 banks today. They called Western Alliance their top buy, and you do see that stock up almost 18% in the trade. They also have a buy on Comerica. That stock is also moving up about 3%. It's been a top among the S&P 500 gainers today. They didn't like everything, though. They also made a call on First Citizens, and they have a sell on that among some other names, and that one's down about 3.5%. I do feel like, Jess, what we're starting to see is some of the breakdown among what bank is doing this and what bank is doing that.
Exactly, Carol. And I have to point out again what's happening with the VIX today. Earlier, we did see it spike just under 30. Right now, it's trading below 27. But again, people talking about, especially last year, where was all that volatility? Now we're beginning to see that again. And if you're looking at that VIX trading as high, potentially at the October levels where that VIX was trading at.
Yeah, we go back to the broader markets here, and yes, it could have been a lot worse. Most of the major indices remain in the red, though we should point out the NASDAQ indices, both the composite and the 100, poking into the green as we speak. The NASDAQ composite up about 0.1% here. The S&P is lower by about 0.6%. The Russell 2000, which of course is very heavily weighted towards the banking sector, about 16 to 17% weighting, down 1.9%.
And you look at sector performances here, and it's actually quite mixed as the indexes have pared their losses over the last hour and are basically at session highs, at least when it comes to the NASDAQ, which is up by 0.1%. Communication services, utilities, that's a weird mix, but you do have media entertainment type companies along with safe plays like utilities and staples doing well. On the downside, energy, look at that, off by 5%. At one point, it fell as much as 6.8% as WTI and Brent fall to 15-year lows. Materials and financials. Financials have been consistently underperformers here the last few days.
Yeah, and in fact, I mean, I was looking for some bright spots. Take a look at Smartsheet here. The software company actually came out with a surprise profit forecast yesterday. Those shares up by about 17%, but that's few and far between here. Most of everything remains on the red. You were just talking about the regional banks, Carol Massar. First Republic down 14%. Bank of America down 1% here on the day, though it was down more than 4% at one point. And United Airlines, most of the airline space down for a second day here, as there are some broader concerns here about economic activity and whether that could affect the airlines. I do want to take a quick look here at the 2-year yield, which is right now camped out around 3.9. That's down about 29 basis points here on the day, but honestly, that does not tell the story here. From peak to trough, the high on the day to the low on the day, a 69, and we're going to round up here, a 70 basis point swing on a 2-year yield. That follows basically 50-plus basis point moves that we saw the previous 2 days. We have never, in the history of the 2-year yield, in its regular issuance since the early 1970s, never have we seen a daily move like what we're seeing today.
We're living in remarkable times. I almost look at that chart, and I know it's hard for everybody, of course, on radio, but it's almost like, is that a mistake? You have to look at it a couple of times. But we have
I did kind of speak it out for them, so they felt it, Carol.
You draw a picture very well with words. Very nice, Romaine Bostic. All right, so lots of
I love when she patronizes.
Bearish sentiment.
She's complimenting you. Come on.
I love. Lots of bearish sentiment out there. We know that. We heard Larry Fink of BlackRock weighing in, some comments, also Ray Dalio. But on the flip side, Morgan Stanley's wealth management CIO, Lisa Shallett, she's stopping by to talk about what's going on. And she does stop short of buying into the latest mega bear case on equities. Bottom line, she says this isn't GFC 2.0. Check it out, everybody.
And so there's an element of this, where this is less about immediate contagion. Again, remember in the great financial crisis, there was a lot of this that was about, cross counterparty credit risk. That's not what this is about.
All right, Lisa Shallett over at Morgan Stanley, Wealth Management CIO. But that's kind of, I think, what many people are saying different is that you don't have the cross-party risk, right? The counterparty risk that you had during the great financial crisis. Yeah. That's not what we're seeing, right, so far today.
I don't disagree with her, but I would also point out, and I don't want to, usurp her comment, but we heard the same comments heading into the global financial crisis as well, because there was a lot of counterparty risk that we weren't aware of.
So you're saying that you feel like the transparency. I mean, I guess this is what we have to get to the
saying
bottom
I'm
of.
saying we don't know what we don't know. That's all I'm saying.
I guess
unknowns.
Yeah.
I guess what I would say, at least,
A nod to Donald Rumsfeld.
and Credit Suisse throws another, kind of wrench into it. But I would also argue, right, Jess, that this is a bank that's been having problems and trying to pivot and kind of work its problems out for a while.
Exactly, Carol. When I've been speaking with my sources on trading desks, they keep saying that and reiterating that even before this week, they knew Credit Suisse had these issues, so they weren't as surprised. But a lot of their clients, when they keep calling, they really want to know, what does this mean? What does it mean for the Fed, and where are things headed right now?
Where are things headed right now? Well, we've been reporting that the Swiss government and Credit Suisse have been holding talks on the fate of the bank, and we've seen indexes trim their losses as a result of that. And the Swiss regulator, FINMA, apparently is going to be making a statement soon on Credit Suisse. So we'll look ahead to that as perhaps a catalyst to stop the bleeding.
Well, I'm glad you brought that up, Scarlett, because I think that's kind of what's been missing here. We really haven't heard a lot from the regulators. Of course, we did get the statement out of Jay Powell over the weekend, but of course we know Christine Lagarde has a previously scheduled press conference, presumably to talk about rates. I assume she'll be talking about something else. Janet Yellen is scheduled to be on Capitol Hill tomorrow, and of course we got a big Fed meeting next week. So we're going to hear a lot from these regulators, I think, over the next few days, and it'll be interesting to see whether that calms the market or not.
Claire Salm was on Surveillance earlier. She's a former Fed economist. She says, I don't know why Jay Powell is still in the black. He should be out there. I mean, this is what the central bank, if you think about it, go back 100 years, this is what it was created for, to make sure that there's financial stability. We know the dual mandate mission.
I listened to that interview, and just to push back on that too, I mean, it has been barely a week. And I think you have to ask yourself here, does he come out before he has all of the information, before he has a solution, and speak to the markets, or do you wait till you have that solution ready to go and then speak to the market?
But how can he have a solution when as you kind of began earlier, right? That we don't really know what else might happen, right? That there isn't transparency, right?
Yeah.
Doesn't he need to maybe just come out and say, we're on it. We're on it.
We're going to do everything it takes. That's what you want to hear?
He takes no questions. He basically comes out, says we're on it, and then he walks away.
Yeah, I've seen that before, right?
Would you believe him, though? I mean, I feel like...
I would believe him.
Okay.
Although there are many questions about why regulators have missed some of this stuff. So we got to go, but we will be back.
That might be an understatement.
Exactly.
That's what Jay said, too. We got to go.
All right, guys, we'll be back in less than an hour's time. We're going to continue this conversation, counting you down to the close on this Wednesday. Radio, TV, Bloomberg Originals, and, of course, on YouTube. We'll see you for Beyond the Bell at 4 p.m. Wall Street time. On Credit Suisse reeling after that top shareholder ruled out upping its stake in the bank. So shares of Credit Suisse having their biggest ever one-day sell-off in Europe. We've seen ADRs down about 25% here in the U.S. The whole banking sector under pressure. So Jess and I have been watching that. So let's get to our roundtable of what you need to know and kind of where we are. So with us is Bloomberg News Wall Street reporter Sonali Basak on the phone in New York City. Also with us, Bloomberg Intelligence Senior Global Banks Analyst. We are talking about Allison Williams. She is on the phone from BI headquarters in Princeton, New Jersey. Sonali, I want to kick it off with you. So Credit Suisse, they've been in trouble for a while. How did they get here? What's the outlook? What's the most important thing that we have to understand about what's going on with Credit Suisse and its strains right now?
Well, the breaking things that we have to think about is a few things. We recently reported, or just about an hour or so ago, that BNP is the first bank we learned of that is reducing counterparty risk in the swap market in a significant way. And so do others continue to follow.
What does that mean specifically? When they do that, what does that mean?
It means that, they have these bilateral agreements, right? Swaps. In this case, it's the swap markets that we're talking about. And it sounds very esoteric, but it is just financial contracts in which Credit Suisse is a counterparty. And now they're just reducing their exposure to Credit Suisse being that counterparty. Allison can stat me if I'm explaining this in a really horrible way. But that is what's happening. And the reason that's happening is because if something were to happen more drastic to Credit Suisse, because remember, people were not necessarily worried about the bank's liquidity. This is a matter of people worried about the psychology here. Do people pull deposits more? The stock is trading at scary lows. The CDS which are basically insurance contracts that insure against the potential for default, are at record wides here. So that's the fear that you're seeing in the market. And the news now also is that bank leaders and government officials have talked about options that include a public statement of support, a potential liquidity backstop so people know that they're safe and they are supported by the government. And ideas that were floated include a separation of the bank's Swiss unit or a tie-up that everybody has been thinking about a long time and watching for a long time, a tie-up in some way with UBS, which is a long shot, but that's something that they would consider.
All right, great summary. Allison, come on in on this. Is this all about psychology, or is this about potential, fundamental problems that are out there within global banking?
So it's about the psychology, but the concern is that the markets can create a reality, and that is the concern. And I do think, to Shonali's point, what a lot of people are worried about now with the U.S. banks, the bigger banks, is that counterparty risk. The one thing I would note is that this is not an SVB, which happened almost overnight. It was stunning how quickly that happened. Credit Suisse has had some issues for a couple of years, and to be clear, they did raise capital in the fourth quarter. They had, very strong capital ratio exiting the year. They had very strong liquidity. The last time that we saw significant stress in the stock was back in October, and I think the concerns there were that people knew that they had to raise capital, and so that was when we saw these very dramatic outflows. There was a lot of media attention. There was a lot of talk about the health of the bank, and that manifested in client outflows. They completed their capital raise. They got that behind them. They said that things started to steady. There's some questions around those statements. But the CEO, I believe, was told Francine Lacroix, who's one of our European anchors, on one of the programs, I believe it was yesterday, that they did see inflows on Monday, so that's one positive thing. But we really need more than that. We need something to boost confidence. The company coming out and saying they don't need capital, that tends not to be supportive of bank shares. So I think that it really does, the one biggest investor said they're not stepping in. They had another investor, a longtime investor, which sold their stock. So I think at this point, it really is up to the regulators to come out and say something to calm the market.
Shonali, I wanted to bring you back in. Where specifically are other cracks forming right now?
This is an interesting, you're asking if there's a fundamental issue or if this is a confidence issue. And a finance executive who's a counterparty to Credit Suisse, who I spoke to literally like minutes ago, what he was saying was what he's afraid of here is the whisper campaign. Remember, Silicon Valley Bank, even when they lost deposits, it was about more than $40 billion essentially overnight. Fear can cause bank runs. That is the worry. And the worry here is that the market will look for cracks, and then they will take those cracks and they will break them wide open. Again, we can't say that's happening. You don't want to cause that to be happening, but investors right now, because of by the way, remember, the markets have experienced an extraordinary amount of pain already. And remember, the Credit Suisse is a globally systemic financial institution with tentacles across the entire globe, not only with wealth management clients, but big institutions. They've been big lenders to corporations. And so, even if their reduced presence here causes a strain in the market because they were such a big player. And even the counterparties who are reducing risk right now are saying, we hate this because it means we are concentrating our risk to a smaller number of banks, and that sucks.
All right, so let's go to that. Allison, I'm looking at JP Morgan, down almost 6% at its lows. It's still down about 5% in today's session. I guess my first question is, do we have to be worried at all about JP Morgan or Bank of America or Citi or Goldman, any of those big banks at this point? And as a result of what's going on, do they just get stronger, bigger, and the like?
So it does seem that the latter is the more likely case. And in fact, one thing that, one thing I think that needs to become more clear in the coming days or week is exactly what is going to be the policy on insurance deposits here in the U.S. So we have two failed banks where depositors are outrightly insured now. So there is a question in terms of, is that the precedent? Does that effectively mean all U.S. deposits are insured? And, that's sort of an interesting angle, if you think about that versus some of the other countries. Does that make the U.S. banks, which have been a safe haven, have gained share in the trading businesses because of their stronger balance sheets? Does that make them even stronger internationally? From a local perspective, J.P. Morgan, Bank of America, Wells Fargo, these are banks that are in all the local markets. Wells Fargo does have the asset cap. They're not as well positioned. Citigroup is much smaller in terms of the branch network. So it's really J.P. Morgan and Bank of America that are in a lot of these markets with these smaller regional banks. And as I said, they are insured or backstopped, but I think people will still look and think about putting their money in a stronger bank. And to the extent they're doing that in local markets, it's really J.P. Morgan and Bank of America that look to be best positioned on that front.
Shonali, with Allison talking about when you're looking at the bigger banks, which ones could potentially hold up better, but I was curious as far as when you're looking at the banking industry in general, where are you seeing potential types of industries that might be less scathed more so than others?
The reason it's such an interesting question is because think about it this way. You have a market right now where investors are sorely burned, and investors in this market today are being burned that won out drastically last year. These are the quants, these are the hedge fund managers that were macro traders, these are the people that made a lot of money off of volatile markets that are now feeling a lot of pain. Why does that matter? Because when the investors feel pain, it's very difficult for them to redeploy more money into different trades. And so there you start to have like a ripple effect here of the pressure on pricing when you look at the market. And so I think that, I'm biased, right? I cover hedge funds, so I watch them really closely. And so I think about where the pain starts and then where it infiltrates. And so you have to, here's what my sources are saying. What is safety? Is it gold, right? Because even the treasury market is looking really scary out there.
Yeah. I mean, it's really kind of remarkable. Hey, Allison, 30 seconds left here. You talked earlier about like regulators having to come out. Do we need Jay Powell, we know there's a Fed meeting next week, to come out and say, guys, we're on it, more to come, don't be worried, or something, just quickly?
I mean, I feel like the Fed did that, right? They did that when they said we're going to protect the depositors and we're going to put this backstop in place for a year. They basically said, look, we're shutting down the immediate risk.
Yeah.
And we recognize that there is an issue. And so we'll see what more they have to say.
You guys, I know you've had busy days, busy weeks, and we so appreciate you just kind of setting the stage for us on this Wednesday of all that is going on, and it's just, happening in real time. Allison Williams, Senior Global Banks Analyst at Bloomberg Intelligence from BI headquarters in Princeton, New Jersey. Shonali Bosick, Wall Street reporter at Bloomberg News, on the phone in New York City. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 3:21 on Wall Street. Things are actually looking up a little bit, at least compared to the way they were before. We do check the markets for you all day long here at Bloomberg. Stocks off session lows. We're getting word now that Switzerland is holding talks on options to stabilize Credit Suisse. And Credit Suisse options, we are hearing, could also include a spin-off or a tie-up with UBS. And the Swiss regulator FINMA, we could hear from them today and tomorrow. First Republic shares downgraded to junk. That stock's lower. What will the Fed and ECB do next? ECB meets tomorrow, the Fed next week. With all this banking mess, there's a lot of speculation that the Fed might have to hold off on those rate hikes. The Dow right now, down 365 points. The S&P 500 down 33. The NASDAQ down 6. Just a slight drop there. The yield on the 10-year now 3.52%. We were as low as 3.39 earlier. NYMEX crude plunging more than 4%. Spot gold, it's up about 0.6%. And that's a Bloomberg Business Flash.
All right.
Over to you.
All right, Denise, thank you so much. Key headline of what Denise said, Switzerland holding talks on options to stabilize Credit Suisse. So regulators overseas in Europe, certainly here in the U.S., are on it. You certainly continue to see those headlines. All right, you are listening and watching Bloomberg Business Week on this Wednesday, brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Your small to medium-sized business could be missing out on an opportunity to claim the Employee Retention Credit. Innovation Refunds has helped thousands of small and medium-sized businesses claim over $3 billion in ERC refunds and may be able to help yours as well. Learn more, just head to getrefunds.com. Want to get right to our guest. Bill Isaac is a former chairman of the FDIC there during the 1980s, when some 3,000 banks and thrifts failed. He's now chairman of the consulting firm Secura Isaac and a member of the boards of directors of Emigrant Bank and New York Private Bank and Trust. He joins us via Zoom from Sarasota, Florida. Bill, so nice to have you here with us. How do you see what is going on? Silicon Valley Bank, 3 regional banks in the past week here in the U.S. Collapsing. You got Credit Suisse. Is this great financial crisis, banking breakdown 2.0, or something different?
We don't know what it is right now, and it's not a surprise that these things are happening.
Why? Why?
Well, because the federal government has been out of control for a long time. This reminds me very much of the 1980s when I was chairman of the FDIC, the late 70s and through the 80s. We had guns and butter approach in the 1960s with the Vietnam War that was not paid for by taxes and big deficits. And we had the Great Society programs of Lyndon Johnson, and no, they were not paid for. So we had very, very high budget deficits, and we had a very accommodated, we'll say, loose Fed policies, monetary policies. And that led to a decade or more of very high inflation. And finally, Paul Volcker was appointed chairman in 1979. I was appointed to the FDIC in 1978, and we worked together. But Paul Volcker was determined and the Fed was determined to bring down inflation, and they did. They raised rates very high, and that led to all sorts of problems. And we're repeating that period right now. I don't know how long it's going to last. I don't know how many firms it's going to.
But I do think we're trying to figure, Bill, if things are different, Jess.
Right. What specifically is different this time around? Is the issue because of specifically depositors?
What's different about the depositors in your mind?
Oh, well, the issue surrounding depositors with those FDIC limits, also usually when you think back, that was more geared toward individuals, but now you're dealing with companies. Is that the hurdle this time around versus in past crises that you've seen?
I don't think that's materially different. We had a lot more depositors back then in terms of numbers and numbers of banks. We had 13,000 banks when I was chairman of the FDIC, and now we have about 4,500 banks. I'm not saying that things aren't different. There's a lot of different things today, but some of the things are not different. Let's take SVB, the Silicon Valley Bank. That's not new at all. They were doing new types of financing, but It was the same problem we had, the crisis we had in 1979 with First Pennsylvania Bank, the largest bank in Pennsylvania, the oldest national chartered bank in the country. And they decided they had a great idea. Let's invest in government bonds, which they did. They loaded up on government bonds at fixed rates. And then Paul Volcker became chairman of the Fed and decided he was going to raise the rates very high and kill inflation.
So history has shown us that we've been here before is basically what you're saying.
We've been here before. And why these guys did this again, I don't know. It was not very smart.
Well, so then do you fault regulators here? You were a former regulator.
Sure.
I mean, is it regulators in the United States, elsewhere, Fed, FDIC, Treasury, and more that have, to some extent, once again, failed us?
Yeah, I'm not trying to pick on anybody, but this is primarily the problem of a bank that had a board of directors that was not doing its job properly, and a bank that had management that was not doing its job properly, and they did a bunch of things that they should not have done, and it failed, and now we're trying to clean it up, and the FDIC and the Fed and so forth will clean it up. This is not something we haven't done before, even in bigger ways than this. So we will clean it up. And should we fault the regulators? Of course we should. The regulators did not do their job. This bank grew in 2 years from $60 billion in size to over $200 billion in size. That's insane.
So
it really is.
Is that a red flag? So help us out here, because oversight obviously lacking. So what stones should we, as analysts, as investors, as regulators, be overturning? What balance sheets, what sectors of the financial system would you be focusing right now and asking lots of questions about, since we've already missed some big things?
The red flags were out here. You tripled the size of more than tripled the size of the bank in 2 years. That is a huge red flag that every regulator, every analyst, every board member, everybody ought to be on top of. Why is this thing growing, tripling in 2 years? That's a huge red flag, and I don't know how they got away with it, frankly, without being brought down faster and sooner. I mean, I really don't understand how this took so long to find.
Bill, we only have about 20 seconds left. Could you tell us, should the FDIC limit of $250,000, should that be changed?
I'm sorry, do what?
Should the FDIC limit be changed of $250,000?
So as we kind of look forward and think about maybe what we should be doing differently, I think there's been a lot of conversation about that $250,000 deposit level. Should that be changed in your view?
Well, it shouldn't. I don't believe it should be increased. I think it was 40 when I arrived at the FDIC, and then it went to 100, and then it went to 250, and I don't see why it keeps on growing. But there's one thing that we really could do, and that is we need to pay attention to non-interest-bearing business accounts. Those, in my opinion, should have much more coverage, much more protection. We need to do that because that money's not hot money. It's money that's supporting payrolls and business, and and we really should not have that money running. And so I believe that we really need to pay attention to that. I recommended that when I was at the FDIC before I left, that we needed to increase coverage on non-interest-bearing business accounts. That would be very, very helpful to the economy when times get tough.
Well, so appreciate your perspective. I know it's a busy day for everybody, including yourself. So, Bill, thank you so much. Be well. Bill Isaac, he's former chairman of the FDIC, chairman of Secura Isaac. It is a consulting firm, and as we mentioned, on the board of directors of a few banks. Yeah, interesting. Carol Masser, along with Jess Metton, here in our Bloomberg Interactive Broker studio. I think lots of questions. And, we've got a market that feels like it's coming down once again, although we still continue to see those big moves in the Treasury trade. So you do wonder, I don't know, in 24 hours, what's the mode? What's the mood? What's the psychology?
Especially just coming into this week, Monday, all of a sudden on Tuesday you see a rebound. Then you have overnight this types of move, and then pairing off some of the session lows from today, that confusion there, and then again seeing investors go more toward income if you're thinking about utilities. But then obviously the question of where are things headed, and still a lot of question marks going ahead to next week's Fed meeting, Carol.
Yeah, no, it's a lot for the Fed certainly to unpack. And if we know, if anything, from the Fed, they say they're data dependent, so they will be looking at that the latest and greatest data, if you will. They'll look at, whether there's tightness within financial market conditions. And, there's been a lot of increasing narrative around this idea that the Fed, is still got to be on its fight for inflation. Some say that they're going to maybe just take a pause this next meeting, perhaps, and then wait and let things settle down a little bit in the financial markets and the worries over banking, and then maybe resume some of its increases. At the same time, we've seen the Fed swaps market price in a 1% reduction in rates by the end of this year.
And in addition
quite
to
a swing in thinking,
trying to find some of those bright spots, we obviously already talked about the softness in retail sales, also producer prices. But yesterday was something that got lost under the radar with the CPI data. There's separate data that looks specifically at wage growth. And if you looked at last month, you began to see that cool again, even though we saw that heat up a little bit in January. That's something that got a bit lost in the discussion, but something traders were pointing to, because as we know, Powell looks toward wages. That's the big thing he always talks about. So he's got to be happy to see a bit of relief there for last month, Carol.
Yeah, no, absolutely. That was the mixed bag that was that monthly jobs report, right? That we saw unemployment tick up, more people came into the workforce. Job creation still strong, but we did see wage inflation, right? The increase is certainly coming down, and that was certainly something that was a positive, because that is something that as you rightfully said, that the Fed has been focusing on. All right, folks, watching markets, we're definitely off our lows of the session, slight gain on the NASDAQ. I'm Carol Masser, along with Jess Metton, and you are listening to Bloomberg Radio. All right, let's get a check on world and national news. Off to D.C. we go, and to check in with Nancy Lyon. She's in our 99.1 newsroom in Washington. Hey, Nance.
Thanks, Carol. The Federal Aviation Administration has been hosting a safety summit today to address those recent close calls at airports. Transportation Secretary Pete Buttigieg is concerned.
Initial information suggests that more mistakes than usual are happening across the system.
Secretary Buttigieg speaking at the summit. Today's meeting comes after the FAA said it was investigating another close call between commercial airliners. The most recent one was at Reagan National Airport near Washington, D.C. It was the 7th since the beginning of the year. Witnesses have been discussing concealed carry laws during a Senate hearing today on a Supreme Court ruling calling a New York law unconstitutional that requires a special reason for carrying a concealed gun. Ruth Glenn is from the National Coalition Against Domestic Violence.
About 14% of women and almost 6% of men in the U.S. experience firearm threats from an abusive, intimate partner.
But Amy Swearer of the Heritage Foundation believes the ruling is fair.
The Supreme Court affirmed that ordinary, law-abiding Americans have a right to bear guns in public for self-defense.
Today's hearing follows President Biden's executive order that was signed yesterday that tightens up background checks and cracks down on gun sellers who break the law. Texas officials say they are taking over the Houston Public School District, the 8th largest in the country. It follows allegations of misconduct by school trustees, as well as chronically low academic scores. Today's move poses a rift between the Democratic-controlled city and the Republican governor, Greg Abbott. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 3:40 on Wall Street. I'm Denise Pellegrini. We check the markets all day long for you here at Bloomberg. And we just heard Nouriel Roubini saying it wasn't clear if Switzerland's government had the wherewithal to bail out Credit Suisse. But we are getting these headlines across. The Swiss National Bank will provide liquidity to Credit Suisse if necessary. No indication of direct contagion. There could even be a spinoff or a tie-up with USB. And for more, we're going to check in now with the First Word Breaking News Desk and Bill Maloney.
And good afternoon, Denise. Like you said, it's all about Credit Suisse worries today as the shares plunged 24% in Europe. Dow's currently down 400 points, was down 725. S&P's pair losses to 40 and NASDAQ pairs losses to 31. The U.S. 10-year yield fell to 3.48%. Gold is up 13. Energy is sinking. And Bitcoin is down by 0.8%. All the main 11 S&P sectors of only telecom, utilities, and consumer staples are in the green. And leaders to the upside in the Dow, Microsoft and Intel, while Boeing, JP Morgan, and Chevron all fell at least 4% and lead to the downside. You mentioned Credit Suisse. The SNB did say they will provide liquidity to Credit Suisse if necessary. And in other news, First Republic fell 18%. Schwab was higher by 5%. Wrapping things up, Adobe reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Denise?
All right, thank you, Bill. And to hear live breaking news over your Bloomberg, type SQUA, go on your Bloomberg terminal. And that is a Bloomberg Business Flash. Carol and Jess.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes to go until we wrap up this trading day. Only Wednesday. Had to check, Jess. There's been a lot going on. We had a repricing going on in assets. We've got the Fed now pricing in, a 1% rate cut this year. I mean, what a difference a week makes if you think about where the 2-year was 1 week ago.
Exactly. And just seeing those roundabout moves, and then especially repricing, if you're looking at those world interest rate probabilities, now all of a sudden we're going from a potential, we thought the Fed was going to continue to hike rates into the summer. Now they could potentially cut by 100 basis points after this next meeting.
It's like whiplash. All right, so let's get with it and to it with our Drive to the Close guest. With us is Phil Taves. He's founder, president, and CEO at Taves Asset Management. They're about $1 billion. They're a registered investment advisor, tactical asset manager, and he's here in our Bloomberg Interactive Brokers studio. So how do you see what's going on and what it means for the investment environment?
Well, so we view it as a potential slow meltdown. One of the ways we frame the market is everyone...
Whoa.
Wait,
slow meltdown. You got my attention. You had me at hello. So go ahead. Okay. So what kind of slow meltdown? That sounds worrisome.
Well, so... With the markets, everyone tends to, you get in this orderly state of things. And last year, even the decline last year, for the most part, was pretty orderly. And everyone just assumes that that's the way it's going to be. So the problem, however, is that often these things come out of nowhere. And like this is a perfect example. I mean, last week at this time, who was talking about a run on the bank? So
nobody.
We all basically woke up to it this weekend. We hear about run on the banks. We start to think about it and the way that rates sort of create lack of profitability for banks. Why aren't we talking about it last week? I don't know. But then in addition to that, you've got the fact that really the
I tried a little bit because you would look at the bank sector, even though as rate expectations were going up, bank stocks weren't going up.
Exactly. Yeah.
So to me, that was a disconnect.
Exactly. Well, so that was there. That was evidence. But so then you've got the fact that the FDIC, as we all realize, or we all knew, but only is insuring $250,000. You've got these massive deposits that are uninsured. And so a run on a bank is actually a real thing again, right? I mean,
which is what Bill Isaac kind of seemed to say.
Right. So it's a real thing. And the statement that the Fed made when they came out to protect everything. And by the way, I think the thinking was coming into Monday is the Fed either, or the government or whoever else protects everything or is massive outflows out of these small banks into big banks. So I think they made the right move, but their statement said that there's systemic risk with these two banks, and so we're going to come in and backstop them. So that's an incomplete statement as it pertains to small banks, right? So maybe there are small banks out there that don't have represent systemic risk. So I think it's an evolving situation. I think, yeah, Credit Suisse, it's a horrible situation today with their stock price and for PR for them. But I think it's like a slow-moving situation, and we're not going to know today or tomorrow. And I think it's just going to have to play out over time. But it creates. Nothing is more.
Is Credit Suisse separate from what we're seeing in the three banks that failed in the
I think
US?
so. I think so because they've had problems for a long time, and they've had a hard time managing risk. But I think it's important to think in terms of for people in their portfolios to think about contingency planning right now. To consider, even if we think we may not move lower, I think it's probably not the end. There probably aren't a lot of people saying, wow, potential long-term systemic crisis with banks, let's invest now. So I think it's probably going to get worse rather than better over the next 3 to 6 months.
And I'm glad you brought up people's portfolios because I know you have a very unique way with how your funds work with this sort of defensive type nature, a bit contrarian when, say, you're in a situation environment like this. How are you positioning at this point?
So with all of our strategies, what we do as a firm is we try to provide investors with ways to be in the markets. So to participate in the kind of conventional assets like stocks and bonds that everyone wants to be in. But what we do is we, with our methodology, try to address the contingency of significant dislocations. And we do that through one of two different ways.
It's like a hedge fund strategy.
Kind of, although many hedge funds are super complex and are betting short and long and taking leverage. So with our strategies, all we're doing is across the board with our strategies, when we're invested, we're just one notional. We're just trying to own the markets, just like an index fund when we're invested. But we try to hedge risk in two different ways. One of them is through trend following algorithms that attempt to move out of the markets in the very early stages of declines before big declines happen and just live on the sidelines. The sidelines don't look terrible right now when one month treasuries are paying around 5%. The other way we do it is we have for example, we have an ETF, for example, that is able to just have options for full notional protection. So if the market moves down, you have potentially have offsetting appreciation in those option contracts. So in either case, what the thinking is then is you may not do as well during the rising market, but if the market, falls into the ice, into the cold water, as we may be doing over the next 6 months, it allows you to just sort of be chill and maybe have some losses, but hopefully not as much losses as the market.
So are you seeing more people come in to your funds now in this situation?
Not as a result of what's happening in the markets. I mean, we have a sales effort and we try to bring assets in and we market primarily to advisors, but we're nowhere near the point where I think the public is looking at this with their stock investments and saying this is a panic mode. I mean, obviously, for those that were...
But should they be? I mean, you did say slow meltdown before.
Right.
That to me says a little bit gets my heart,
So we did. So you've got the fear index, which is the VIX index,
right?
And it's a contrarian indicator, and when it's the lowest, around 10 or 11, that's when you should have the most fear, and when it's the highest, that's when you actually want to invest in the markets.
It's at 26 and change right now. So
so it's elevated, but it's not like as high as it can be up in the 60s or 70s or even higher. But so people aren't panicking. I'm not sure I would say that people should panic. Our approach, which we're trying to spread the word, and we have been for decades now, is that most people get it wrong. Like the idea is not to outperform the markets or necessarily even to perform as well as the markets. The vast majority of people just want to have gains above inflation, but to address the contingency of big falling markets. Why is that so hard right now? It's so hard because even during the financial crisis, the decline only lasted 6 months. It can get much worse. And I think that's what one needs to think about and, not panic, but address. Address that possibility. Think about it when you're building your portfolio.
It does feel like a churn, and it does feel like certainly if the Fed, even if it pauses and then resumes interest rate hikes, because inflation is still a problem, that this could go on for a while. Just quickly, 5 seconds.
Yeah. So the Fed is in a new situation. They're creating risk rather than taking it away.
All right. Come back soon. This was fun. Phil Taves, he is Chief Executive Officer at Taves Asset Management here in studio. This is Bloomberg.
your company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters, I'm Denise Pellegrini. Credit Suisse in the Wall Street glare. Shares of Credit Suisse plunging today after its biggest shareholder, Saudi National Bank, said it would absolutely not inject more cash into the Swiss lender. But now reports say the bank is asking the Swiss National Bank for support, and we are hearing that looks like it's getting it because the National Swiss Bank says it will provide liquidity to Credit Suisse if necessary. More problems for regional bank First Republic. Bloomberg's Steve Rappaport is tracking those developments.
Denise, S&P has cut the San Francisco bank's credit rating to junk, down to BB+ from A-. S&P saying it thinks outflow risk at First Republic remains elevated after the collapse of Silicon Valley Bank, and this concern by S&P comes even with all the regulatory help FRC and other regional banks are being offered by the federal government, including that special lending facility where banks can borrow against the full assumed value of assets, even though the assets may currently be worth less than that. Denise?
Yeah, and Steve, right now, shares of First Republic, they are down more than 21%. And we're also hearing Diamond Sports Group has filed for bankruptcy. This is America's largest owner of local sports channels. It's owned by Sinclair Broadcast. And Steve Leuthold, money manager who founded the multi-billion-dollar investment firm that carries his name and called the bottom of the stock market with near-perfect accuracy during the financial crisis of 2008-2009, died. Leuthold was 85. I'm Denise Pellegrini. Those are some of the company stories we're following for you this hour.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on this Wednesday. Carol Masser along with Jess Menton. As you know, Tim is on leave. We're watching the markets. Just got about 4.5 minutes left to go in the trading session, Jess, and really kind of just sitting with the comments of our last market guest about kind of more shoes to drop, if you will, in the equity markets. We could see potentially a big drop. You've been thinking about small caps, which we talked about a lot here on Business Week with Gina Martin Adams yesterday.
Because Gina and her team have talked a lot about how that can be the canary in the coal mine, especially since we've recently seen the Russell 2000 underperforming the broader indexes. That was a different story in recent months because they had been outperforming. So that was potentially a glimmer of hope because typically, as you know, they're the ones to bottom before large caps do. But now it's a confusing dynamic because what does that mean? And does that mean there's going to be more pain for larger cap companies?
No, it's interesting. She talks so much. She's a technician. She looks at the technicals and she, you know, the S&P 500, certainly some key levels, but especially those small caps, which just got killed last week, much worse than the big cap names. But she's been looking at some of the technical levels that they've been taking out in the small cap sector. And so you do wonder, what does that tell us about what's to come?
And also, small caps were the ones that were supposed to be pricing in a recession almost basically 2 years ago. They've been through so much pain. So that was the optimistic view coming into the year that they would potentially be the ones that could help this out and lead the way. But now this is a change in dynamic. And that also tells you maybe the S&P 500 and more broadly those bigger stocks have not priced in the pain of a potential economic downturn.
I mean, what's so important to keep in mind as we have these discussions, right, is what you need to think about is valuations, right? And are stocks, financial assets in general, are they priced for the environment that's to come? And that's what's at question right now, right? What kind of recession do we get, if any? What kind of global recession do we get? Is there more shoes to drop in terms of banking pressure? So that's kind of the tricky point we find ourselves in.
It is. And specifically, if you're looking at valuations when it comes to the financial sector, Gina and her team at Bloomberg Intelligence, they were looking at how that was trading around 1.5 times earlier this week. It was actually nearly close to 2 times in early February, but still, they feel like that's just a modest discount. So not cheap enough yet for a lot of investors to come in and buy those stocks, Carol.
Right, which some would say that, okay, there's more to the downside, certainly on the equity side of things. All right, folks, just a few minutes left in today's trading session. Stocks definitely off their lows of the session. The NASDAQ, call it little change, is down about 0.2%. The S&P down about 0.9%. Time to head over to our TV team, check in on the markets, our cross-platform coverage beyond the bell, and the market close starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us Beyond the Bell. It's a global simulcast with Carol Massar and Jess Menton. We welcome our audiences across Bloomberg Television, radio, and originals, and those folks streaming on YouTube. Here we are, Carol Massar.
Yeah.
This is a real-time stress test, not only for banks, but really kind of a gut check, I think, for the markets, and I guess really a binary decision right now for regulators worldwide.
Yeah, I mean, and what's interesting is you do see, I feel like, the equity side of things moving off their worst levels of the session is it does feel like regulators are increasingly coming in. Although I have to say, Jess and I just had a conversation with Phil Taves. He's CEO over at Taves Asset Management. He says we are in a slow meltdown, and he expects 50% drop in stocks because he said ultimately the Fed is going to be working against us longer term.
And again, pointing back to what we were looking at with this data, whether it's a softer retail sales number, also the producer pricing is coming in cooler than expected. That's really important because if you look at that PPI-CPI spread, it has been improved vastly over the past 2 years. And the reason it matters, typically it bodes well for corporate margins and the stock prices. So that's a trend that investors want to continue to see over the coming months with that data.
Yeah, the latest data prints, of course, do support the case for the Fed to pause. But what you said, Carol, is really important because it goes back to that idea that at some point the Fed will need to make a decision about whether it really needs to come in and save the financial system, the banking system, or it needs to continue fighting inflation. And those two may be at odds with each other.
Yeah, and we should really point out, though, too, the global nature of this, too. We talk so much about what we're going to hear out of Jay Powell and the Fed. Christine Lagarde has a big press conference ahead of her tomorrow over there in Europe. Of course, we talk about an ECB that's going to have to figure out what to do with Credit Suisse, but this really goes beyond that. You have a market here in the United States really trying to make sense of it, and I guess they're taking it in stride. You are seeing a little bit of a green on your screen, and we'll start with the NASDAQ composite, because it is going to finish in the green on the day. Less than 0.1%, but I think some folks will take it, given that at one point on the day, it was down around 12,026. The Dow Jones Industrial Average down on the day by about 0.9%. The S&P 500 going to finish lower by about 0.7%. And we should point out the small caps and the mid caps heavily weighted to that financial sector, particularly when it comes to the medium-sized banks. They're down about 2% on the day.
Yeah, I think it's interesting, Romaine, that we did see some buying into the close, certainly on the equity side of things, and we're finishing, pretty much near or just off our best levels of the session. Having said that, I'm focused on the VIX, up 2 points here, just under 26. But, Scarlett, I think about the days when things were really coming undone. You saw the VIX spike. I feel like there's still a lot of complacency in the market when there are so many questions about what comes next here.
Yeah, I've been puzzled all day as to why media, entertainment, and utilities are the leading gainers here in the S&P 500. It's a weird mix because normally you have utilities, household personal products, food and staples. Those are your defensive sectors, quality earnings, dividends, all of that. But you throw media and entertainment and growth names in there, it just doesn't really gel in my mind. Of course, on the downside, energy stocks are the big losers on the day, with WTI and Brent crude falling to 15-month lows, and banks and insurers, we can't talk about it enough, each down by at least 3.6% on the day.
All right, so let's get to some of the individual gainers in the session. A lot of these names top in the S&P 500. In fact, I think they all are. Among them are some of the mid-cap banks, if you will, and that's a result of UBS out with a call on 19 names, some buys, some sells, some holds. Comerica, it is number 2 gainer in the S&P 500, up 3% in today's session. So UBS coming out with a buy on that stock specifically. Schwab, also top in the S&P 500. In fact, it's the number 1 gainer in the S&P. It's up 5% as we speak. Credit Suisse upgraded to outperform Charles Schwab today from neutral. Analysts saying they are taking advantage of a sharp share price decline. It's still down about 30% year to date, but we're hearing analysts in general come out and say, look at this name. It's been beaten up. There's some opportunities. Netflix, check it out. Top in the S&P 500 and in the NASDAQ 100. Oppenheimer out with a note saying that Netflix looks attractive following recent weakness, showing a buying opportunity. They also affirmed their outperform on the stock. So I do feel like we're continuing to see that narrative from some of the analysts out there.
You know what the great thing about Netflix is? They'll have a documentary out on this banking crisis by next week, I'm sure.
I thought she was going to say.
I think that's all they show right now, are just scandal documentaries. Jess, what do you got?
There is a lot.
I'm going to take the decliners. I obviously have to start off with what we're seeing with Credit Suisse. Looking at that ADR, it paired a record 30% drop, closing lower by 14%. This comes as obviously it's Switzerland's central bank and financial regulator did say that Credit Suisse will receive a liquidity backstop if needed, obviously an effort to try to help this slump in confidence that's happening around this troubled lender. I'm going to move next over if you're looking at First First Republic, that ending down a little over 21%. It did lead a rout when you're looking at what's happening with U.S. regional peers after being cut to junk by two major credit firms. And then lastly, we're going to take a big look at what's happening with these bigger banking giants. If you're looking at JP Morgan, down just under 5%, had been down more than that in this session. But again, some of these bigger lenders, when you're looking in the U.S. side of things, also getting hit today as well.
And I just want to add one to your list, really a group here. The energy sector as a whole having an awful day. The S&P 500 energy sector down more than 5%. That's the worst day that we've seen going back to September of last year. And they're now back down to those October lows. A lot of volatility in the commodity space and, well, a lot of volatility in the treasury space as well. Let's take a look at it here. 33 basis points down on a 2-year yield. We talk about the flip-flop here. We were above 5% last week, dropped down to 3.93 on Monday, then rallied, and then we went back up, of course, on Tuesday, and now we're back down to 3.92. Similar story for most of the other parts along the curve. The 10-year yield down 22 basis points, and your 30-year yield right now, Scarlett, down about 15 basis points on the day.
Yeah, so as a result, we're seeing the yield curve steepen as well. It's still the spread between the 2s and 10s is still somewhere in the neighborhood of 41 basis points. But a lot of people point to that steepening yield curve as perhaps the last bit before a recession is forthcoming. Of course, the inverted yield curve is a signal of recession, but typically what happens is that it'll start to steepen right before the recession actually hits.
Yeah, I want to go back to commodities because we did see the Bloomberg Commodity Index down about 2% today, and we did see them dropping to a 14-month low. Like, if this sticks, like, what does this say potentially? Is it just worries in general, or are we starting to see further cracks in the global economy here?
Something I wanted to point out, tomorrow actually marks the 1-year anniversary from when the Fed started beginning this tightening cycle. And all the conversation coming into this year was, when are we going to beginning to see these sort of lagging type effects? You come into this week, now we're beginning to see that.
So, Jess, does that mean that, well, next week, is that the end of the tightening cycle?
That's the $1,000,000 question that everyone wants to know, Romaine.
Do we still care about earnings?
We do, because Adobe has just come out with its numbers, and this is the regularly scheduled fiscal first quarter earnings, and we have adjusted EPS of $3.80, better than the consensus estimate of $3.67. Revenue in the period was $4.66 billion, slightly higher than what analysts were looking for, which was $4.63 billion. As for its full year forecast, it sees full year adjusted EPS of $15.30 to $15.60, higher than what its previous range was, and it sees its second quarter adjusted EPS of $3.75 to $3.80, whereas before it was looking, or I should say, Wall Street analysts were looking for $3.76.
Yeah, interesting numbers. And look, I mean, we've spoken so much with the folks down at Bloomberg Intelligence, and they've reiterated this. The subscription revenue for this company has really been on fire. That pivot that they made a few years ago that everybody kind of derided and thought they wouldn't do has really paid off.
They invented it.
And I know, as somebody who's paying for a subscription grudgingly, they got me. And they got a lot of folks out there. But that's the idea, though, too. We talk about the resiliency of the economy and where you can find it. And I think some people would point to some of these software and services companies, particularly the ones that have that subscription model, particularly those tethered to corporations.
Well, it's interesting too, Romaine. You mentioned Smartsheet earlier. They're a software company. Sentinel One, another one. I mean, these are smaller, kind of $4 or $5 billion market cap. Both came out with earnings, and they were rallying in today's session. So this software space is interesting, and I think if companies, if they need it to, run their business or to find kind of better productivity, I mean, this is where they're going to spend their CapEx money.
I'm curious, though, I do want to go back to the Fed, because there's this talk here about this binary decision they have to make. But you look at these earnings out of Adobe, you look at all the earnings we got this earnings season, and there is strength, there is stability, at least, if you will, to a certain extent here. And I wonder how much that becomes part of the conversation. Can you sort of isolate what's going on in the banking sector and say the rest of the economy can withstand further rate hikes if necessary?
When I've been speaking with my sources on trading desks, Romaine, they're getting so many calls and fielding it from their clients, and a lot of them have been coming in. They've been waking up at 3 in the morning, going to the trading desk at 6 a.m. to try to field these calls, and obviously the clients want to know, where is this headed? What does this mean for the Federal Reserve?
The problem is, even if it's limited to the banking sector, those banks will become more conservative in how they lend out money and how they deal with their customers. And at some point, that's going to filter down into the real economy as well. So you have pockets of strength in with companies like Adobe and other software names that rely on that recurring revenue, but eventually that erosion from how banks will service their clients will start to be felt.
Psychology versus fundamentals, right? This is the debate that we're in, and ultimately psychology can affect fundamentals, and so that's where we can get to, but we'll see how the Fed calls it. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, Bloomberg Originals, and YouTube. We call it BS.
Love YouTube.
I know you do. It's the cats, right? You watch the cats.
Cats? No.
A lot of cat videos.
No
Cats on those Roombas?
All right, we'll see you tomorrow. Same time, same place, everybody. All right, everybody, we are going to talk about budgets. It's on the minds of many consumers. We saw that play out a little bit in the retail sales numbers today. It's not just about global banks, although that is obviously very important. U.S. retail sales, we got a data point this morning. Jess has been talking about it. We all have been. U.S. retail sales falling in February after surge in the prior month, suggesting consumer spending, while holding up, is getting challenged by high inflation. The value of overall retail purchases decreased 0.4% after a revised 3.2% advance in January. Back out gasoline and autos, retail sales were flat. So let's get into what's going on with retail and the health of the consumer. With us, Katie Thomas. She's lead at Kearney Consumer Institute. They're a consulting firm. She joins us via Zoom from Pittsburgh, Pennsylvania. Katie, nice to have you here with Jess and myself. So retailers and retail, getting tired, getting nervous. Are consumers running out of money to spend? How are you seeing it?
You know, right now I'm still not that nervous. I've been pretty bullish on the consumer, and I say that way. You know, we talked to consumers about their spend over the last 6 months. 2 out of 3 said they were still spending the same, or they were still buying the same products and services despite the price increases. You're seeing that continue to be pinched, but today's numbers, given that they were flat, ex gas and auto, are actually pretty reasonable for February. You know, when you take into account weather, sort of removing the hangover of January numbers, New Year's resolutions, and all of that. So I think, you know, you're seeing consumers are making trade-offs. So are they evaluating some degree of pullback? Perhaps. But what they're really doing is making trade-offs across their wallet and across sectors rather than feeling like they have to have some massive pullback and spend overall.
Something I was curious about is the goods versus services equation. Are you seeing any changes continuing on that front?
A little bit. I mean, that's a great example is looking at the restaurant number there. So you're seeing consumers, you know, there was a little bit of softness there, down 2.2% versus last month. And when we talked to consumers, they said that's actually an area where they like to cook at home now. So they can splurge on, you know, a nice cut of meat, a nice bottle of wine, and they're willing to spend on those goods rather than the services. More broadly speaking, there's still a little bit of the pandemic where we're still happy to be back out and about. And really, you're seeing a bit more of an investment in services from hospitality to concerts and events and, you know, kind of supplanting some of the material goods. But, you know, it's really a mixed bag depending on the consumer and their financial situation.
So when you talk about the consumer and retail, though, you can't talk about it in a vacuum. And so I'm thinking about the news flow of the past week, and I haven't heard you mention it. So how do you factor that in? Because I feel like we were just talking about psychology versus fundamentals. Psychology can affect fundamentals. It does impact fundamentals. There's got to be folks out there, consumers are saying, I'm getting a little nervous. Bank runs?
Yeah.
Who would have thought? I lived through a pandemic, and now I'm talking about bank runs. This is things that people dealt with, you know, over 100 years ago.
Yeah, I love that, psychology versus fundamentals. I heard you say that. I may have to steal that. Well, the interesting part there is, you know, consumer sentiment has been pretty mediocre for a while now, but worse than actual consumer spend. So I think that's what you're continuing to see with the issues with the banks is you're seeing that uncertainty, that frustration. To your point, consumers are like, when is all of this going to end? So sentiment is mediocre, but it's not necessarily driving a huge pullback in spend because people, like the wage market is still strong, the labor market is still strong. So they're still feeling like they have money to spend. So in some ways, it's sort of that battle of like sentiment versus reality. And it is that psychology of look, I'm sick of bad news. I'm sick of one thing after another. But then you almost get a little bit of a shift into that YOLO mentality, the pent-up demand from the pandemic of like, with everything that's going on, I'm just going to keep living my life and spending on the things I want to spend on.
That's interesting because we've seen some of this wage inflation data pull back a bit, but it sounds like you're not seeing that change yet in the consumer behavior.
Not totally. I mean, consumers are evaluating. So it's just really that nuance of if you want to think of it as like a major pullback versus a trade-off. I think consumers are being incredibly thoughtful about those spend versus splurge categories. So we've heard from, big box retailers through dollar and discount stores, they've seen an uptick in higher income consumers. That means people know they want to get the best bang for their buck on those everyday items where they are feeling inflation. Food and gas is where people have felt inflation the most. That's where they're really being thoughtful. But in order to save there, they're also shifting that spend into other categories where they're still wanting to splurge or save a little bit. So it's really about evaluating, all those different things. And I think that's why you haven't seen it necessarily hit one sector that hard, is because in a lot of ways, consumers, it's very individual in terms of where, they're really deciding they want to spend.
So when you look, you talked about the past 6 months of data. So I'm just curious, as you try to get kind of data in real time, what do you look at? Is it revolving debt? What is it that you look at to see more about the health of the consumer and then ultimately its impact on retail?
Yeah, absolutely. Those are the numbers right now that do give me a little pause, do give me a little concern. So while I've generally been bullish that consumers are just informed, thoughtful, savvy in terms of how they want to spend, looking at savings rates, looking at increasing credit card debt, likelihood of default. We're seeing all of those numbers move in the wrong direction. Yes, exactly. So those are the numbers where you're seeing there really is the reality in the market kind of moving in the wrong direction. And those are the most concerning to me, especially as you start to break it down by income and sort of the disproportionate effect.
The credit card just hit a new high, I think, a couple of days ago, like within the last week. I mean, that's got to be worrisome.
Exactly. And for a while, people have these record savings rates and the stimulus checks. So, you're seeing people evaluate those bigger projects, delay maybe, the bigger spend. So that's when it comes to big household purchases. You saw a little bit of softness, for instance, this month in furniture stores. People invested in their homes. Now they're pressing pause. They're evaluating a little. I'm going to splurge on a beauty and new lipstick instead of, a new couch this month. So that's really some of that, kind of moderation and the cautious outlooks you're hearing from honestly most retailers right now.
You brought up specifically the savings rate and people adding to that. Where exactly do you think, when you're crunching the data, are people more willing to save on certain things rather than spend? Because I know you brought up the furniture and those other details, but is it more geared toward a way to gauge as far as where the economy is headed? And is that why they're going to potentially put more money aside?
Well, I actually meant quite the opposite, which is we had record high savings during the pandemic from the stimulus checks, which have now dwindled down to, I think the last number I saw was 2 to 3%, right? So almost record lows there. So yeah, I think, in general, consumers are really, it's sort of some of the things related to the pandemic. So, what was I able and not able to do during the pandemic? Like I said, I think that everyday items is where you're seeing consumers want to be almost as frugal as possible, where they want to make sure they're getting the best bang for their buck. And that quality really works hard for them. I mean, over 70% of consumers said they will spend more on things if they feel like quality is there. So that's, again, where you get into these muddy definitions of, like, it's not just low price. It's got to be that right sort of nebulous price-value equation.
So Katie, you work in the consumer space. You've got clients, and I'm just curious what those clients, whether they're, consumer product companies and the like, what's the question that they're coming most often to you about right now? And just got about 45 seconds.
Yeah, I mean, it's just what we're all saying right now, which is how do we try to predict for the unpredictable? And what we've seen throughout the pandemic is just so much change so fast. Consumers buying a category one day, stopping buying it the next. So it's really trying to hone in on how to think about these behaviors a little bit differently. How do we plan for them? How can we become more agile and, rethink the way that we're thinking about our forecasts and demand planning in a way that allows for some of these shifts that are happening really quickly and, allows for these potential supply chain risks. It really continues to be those discussions around agility that are really top of mind for clients right now.
5 seconds. Do you think we'll see some consolidation as a result in this space right now in the consumer space?
Yeah, absolutely. Consumers are overwhelmed with options, as are the brands. So I think you'll continue to see a little bit of culling of options to make life easier for everybody.
All right, good to check in with you. Katie Thomas, she's a lead at the Carney Consumer Institute, joining us via Zoom from Pittsburgh, Pennsylvania. Carol Masser, Jess Manton, you're listening and watching Bloomberg Radio.
headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is now 4:21 on Wall Street. We check the markets all day long for you here at Bloomberg. What a day it was. Crazy day. And we do have some upside news to tell you about, because Adobe shares are up just about 15%, maybe even a little bit more now. Adobe boosting its earnings forecast for the year, signaling that demand for creative software remains resilient. Profit $15.30 to $15.60 a share this year, excluding some items. And the previous range topped out at $15.45, so that's seen as a beat. And Adobe, of course, long the leader in creative software. We had really a crazy kind of schizophrenic up and down kind of day on Wall Street, and stocks closed mixed. The Swiss National Bank and the country's regulator indicating support for Credit Suisse late in the day, saying the lender does meet the capital and liquidity requirements imposed on systemically important banks, and that the SNB will provide Credit Suisse with liquidity if necessary. That's after Credit Suisse shares really tanked earlier and things unraveled after its largest shareholder, Saudi National Bank, ruled out more assistance to the lender. The biggest U.S. banks have been whittling down their direct exposure to Credit Suisse for months, though, so that could limit some of the damage, and also interest rate cut speculation really taking hold. This news courtesy of our Kathleen Hayes. Quarter-point hike on March 22nd is now given less than even odds, and traders are pricing in a full point of Fed cuts, guys, from peak by the end of the year. The yield on the 10-year right now, 3.46%. We were 3.39, though, earlier today. Rule of thumb is that means mortgage rates could soon be around 5.5%. That could give the economy a little bit of a kick, too. The Dow down 281 points. The S&P 500 down 27. The NASDAQ up 5.9, actually just about 6 points. NYMEX crude plunging more than 4%. Spot gold, though, it closed up about 0.7%. And that is a Bloomberg Business Flash. Carol and Jess, back over to you guys.
All right, so appreciate it. Denise Pellegrini there. Well, as we've been saying, it was just about a week ago that we saw the 2-year pop above 5%. Folks talking about maybe a 6% on the 2-year. Now bond traders are ramping up bets, as we just heard Denise talk about, of a Fed that actually cuts later this year, pricing in that drop of more than 100 basis points in the central bank's policy rate from its expected peak by May. So let's get to what the financial markets are telling us and where the Fed is likely headed. Let's head to our Princeton, New Jersey bureau, check in with Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey. Ira, so glad to have you here with us. I have to say, when I saw that story in Headline Pass earlier today about the 100 basis points drop, I was like, wait, what?
Right.
What happened here? So tell us about the market action that we've been seeing in the rates market over the past week or so and how you're making sense of it.
Yeah, so I think there's two big things. I mean, one is the story that people are worried that financial contagion could wind up pushing the United States and indeed the global economy into a recession a little bit earlier and maybe make it a little bit deeper than people thought. So that's one reason why you're seeing these early cuts, I think, priced into the market. And secondly, and you know, this goes to what you were talking about just before the break, what Denise mentioned, the fact that we're no longer pricing for a full 25 basis point hike next week and instead kind of 50-50 odds, but really there's almost a trinomial distribution, right? There's a non-zero chance that the Federal Reserve might actually cut interest rates next week if things were to get really bad. Now, I don't think that that's likely, but still there are some market participants who are worried that the Federal Reserve might have to be even more aggressive in order to stem a potential financial crisis.
Ira, I was reading your note in the terminal earlier today where you were talking about how a pause or a 25 basis point hike doesn't mean there would be early cuts. Tell us more about that. Why is that?
Yeah, so you know, the Federal Reserve is going to have a really strange balancing act that it has to do next week, where it firstly has to say inflation's still a problem, the underlying economy is still good, services, which aren't necessarily as affected by interest rates in the financial sector, is still growing at gangbusters in terms of inflation and price increases. So the problem that the Fed has is how do they communicate that they still want to get inflation lower and at the same time fight against financial instability? So I think that one of the things that if the Fed does actually hike next week, which I think that they might if things settle down a little bit between now and next Wednesday, then they're going to say, we're going to use our balance sheet, we're going to use our lending tools to make sure that the financial sector has the liquidity it needs, but at the same time, we're going to keep interest rates relatively high until we see signs that inflation is under control. So I think that some of the whipsawing that you're seeing in the market might even get worse as Jay Powell turns out, comments on early cuts are not likely to occur.
You know, it's funny, before we started with you, Ira, Jess and I were talking about the WIRP function, the World Interest Rate Probability Function on the terminal, like over the last week or so. Like, it's just been wacky. Having said that, there has been so much volatility in the Treasury trade. Does that also say to you that, or what we've seen so far, is it likely to continue, that we can see these extreme swings, which is just a reminder that when the Fed meets next week, they're going to look at exactly what's right in front of them, maybe not necessarily what happened a week ago?
Yeah, well, they are going to take into account what happened this week. Obviously, the financial instability. They're still going to talk about the February inflation data that we got on Tuesday. So we're going to definitely be looking backward.